All the talk really has been about cost discipline for the last few quarters. That appears to be bolstering profit. But there's still a big question here about growth, particularly when it comes to production.
Hi, Romaine. Thanks for having me. So you're right. Both companies are probably going to be eking out small production gains this year. Exxon beat expectations in the quarter. Chevron fell a little bit short. But to your point, they're being very cost disciplined because they realize this is a cyclical business. And if you go back a decade ago, when these companies were spending every dollar they had from operating cash flow and then some to boost production, that did not work out well. Investors were not happy. And so they've, in the last, call it 5 years, they've taken a much more, I guess, subdued approach to capital spending. And you can see that in their on their balance sheets. The cash that they have on hand right now is really quite remarkable.
But balance that out for us. You know, because when you hear that, that sounds great, certainly in the short term, but longer term, I mean, these are natural resources companies, and these are companies that are capital intensive. These are businesses that are capital intensive. So what's the balance here between sort of keeping those costs in check, but at the same time spending enough to ensure that, you know, 10, 20 years from now, they still have that revenue stream coming in?
Right. It's a great question. And that balancing act, if you will, is difficult. I think these companies and a lot of, pure play E&Ps would be fairly happy with, mid-single digit production growth every year to try to offset that decline rate because it is a declining resource play or business. But you don't want to get too far in front of your skis and overspend and then discover that you're now entering the down portion of a cycle. This industry as a whole really significantly underinvested between 2014 and 2021. And so oil prices moving up into the 80s, into the 90s, and then some last year, I think is in part a reflection of that. Now, an Exxon or a Chevron is assigning their capital decision-making or their capital plans, if you will, not just based on where they see oil prices this year, but for 3, 5, 10 years out. And so they are trying to, maintain a decent balance where you can eke out decent production growth on the one hand and placate investors who are there for the dividends and the buybacks. It's a very difficult balancing act for them to follow.
I am curious your thoughts, though, on the direction of the price of oil and gas here. I mean, there are a lot of people sort of looking at these results, a lot of sort of analogies being drawn to sort of those halcyon days when oil was firmly above $100 a barrel as being supportive of the valuations today. We're not at $100 a barrel, as I'm sure you know, Stewart. Where do we go next here?
Yeah, so I think, $75 to $80 oil on a fundamental basis seems about right to me for 2023. Now, by comparison, last year oil averaged $95 a barrel. And of course, things like the Ukraine war were a big catalyst for that to happen in the first place. But when we're talking about the risks, either upside or downside to oil, there are really two big ones that investors are keeping in mind this year. On the upside, it's the potential for the China reopening trade to really take off. Richard Dealey in that segment you had earlier just alluded to that we're all kind of waiting for the China reopening to occur. It hasn't really happened yet. But on the downside, there of course also is the risk of a recession, particularly in the US. And if that happens, oil prices and GDP are very well correlated. So if GDP suffers, oil prices will suffer along with them. And that, I think, is another part of the reason why an Exxon or a Chevron are being somewhat conservative in how much they're spending. They're certainly spending more than they did last year, but not massively so. And I think it's those concerns, the things that keep you up at night if you're an energy executive. It's what happens to demand.
I am curious. We only have time for about one more question. You mentioned Dealey and Pioneer Natural, of course, kind of the end of the era with Scott Sheffield stepping aside. But before this announcement with Dealey taking over, Sheffield had given an interview to Bloomberg back in March, and he kind of talked about the limited opportunities right now in U.S. shale and the idea of sort of how that was going to, of course, hamstring deal making and a lot of other things, of course, that built Pioneer into what it was. Where is the next big thing? I hear so much talk about whether it's Guyana or some of the countries in Africa or even maybe a resurgence in Venezuela. Where is that next thing, if at all?
Yeah, so I think that shale oil is getting a little bit long in the tooth. Shale gas started around 2006, shale oil probably around 2009, 2010. So that's an awful lot of inventory that's been picked over. A lot of companies are spending tried to downspace their wells, and they've discovered that there's a limit to how far you can go with that. So I think that we're going to turn back towards the traditional large elephant wells, if you will, and that's looking offshore. The advantage of offshore is once you do find something, you can produce with very low decline rates for a long time. The downside of offshore is that it takes a long time to get to first oil. It's really the province for the bigger pocketed players, and it's not something that every E&P can participate in.